What's up guys, welcome back to the channel. In today's video I want to continue my discussion on taxes on investments. In my previous video I went over the broad basics of how you're taxed on your portfolio investments. This is interest, dividends, and capital gains. But while researching that video, I finally understood the implications of the long-term capital gains tax and how basically if you're rich, you don't need to pay taxes if you don't want to. As always, before we go any further, I am not a CPA, I am not a financial advisor. This video is for entertainment purposes only. Do your own research, not financial advice. To qualify for the long-term capital gains tax rates, you can do that by two ways. The first one is you're paid a dividend, and that dividend is considered a qualified dividend. In order to qualify, you need to hold the stock that pays the dividend for a 60-day period in the 121-day period up to the ex-dividend date. Basically, if you just hold the stock long-term, it'll always be qualified. Additionally, if you hold a stock or asset for longer than a 1-year period, so this is 1 year plus 1 day, when you sell it, any capital appreciation that you earned on that sale, it is considered at the long-term capital gains rate. And when you look at the chart, there are three tax brackets, basically. There's 20% if your income is, if you're single or married, for this amount, and then it's 15% for these amounts. And when you watch other YouTube videos, they'll just say it's probably 15%. You know, they're assuming that if you're single, you have about $39,000 worth of income, and if you're married, it's about 78. So they just say factor in that your capital gains long-term rate will be 15%. However, I was staring at this 0%. And I was thinking really hard about it. And then I started just on a piece of paper running the math. And it is shocking how easy it is to pay no taxes using the long-term capital gains tax rate. To research this video, I spent a lot of time on the IRS's website reading Publication 17. I'll be honest, it was not very clear or straightforward even on the IRS's website. I also went on several capital gains tax calculators. I went on 4 or 5 different ones, and they all gave me different numbers. For the exact same numbers, they spit out different results. So this is complicated, and it is difficult for people to understand. And even, you know, aside from the official TurboTax maybe software, certain websites can't even get this right. How I'm going to explain it in this video is how I understand it. If you're a CPA and you know more than me, then leave a comment down below so the community can learn together. But how I understand it is there is earned income and then there is unearned income. And unearned income is money received from sources other than a job. This is also called passive income, portfolio income, investment income. And when you look at this tax bracket, we'll do the long-term capital gains tax rate for single filers. It just says your income, and I was confused. I said, is that, you know, your taxable income? Is that your raw income? Is that your investment income plus your earned income? I was very confused. And how I understand it is it's your total taxable income from both your earned income and your unearned income. So once you go over $40,000 for your earned plus your unearned taxable income, then you start paying this 15% long-term capital gains tax rate on just your unearned income. The reason why they have to be combined is this would be a glaring loophole. Let's say that you had no job, you had no earned income, you then sold millions of dollars worth of stocks because your earned income was less than $40,000 because you don't have a real job, then you wouldn't pay any capital gains tax. So it has to be your earned plus your unearned. However, the tax rate starts after you factor in your earned income. So this led me down a rabbit hole of hypotheticals. The first one being, all right, let's say you have no job. How much worth of investments do you need in order to have an unearned annual income in which you pay no federal taxes? So let's say that you have no job and you're lazy, young, and rich, and you inherited everything from your parents, and they said, here is a large investment, just live on the unearned income that you get, you don't have to pay any taxes on it. In this hypothetical, let's just say that he inherited Coca-Cola stock, and the Coca-Cola stock pays a 3.37% dividend yield. He is not reinvesting the dividends, so he is living on the dividend income. Now, obviously, you could have a diversified portfolio of several dividend stocks like Johnson & Johnson or AT&T, but for simplicity, let's just say one stock, Coca-Cola. We also have to now factor in the standard deduction, because this is, if you're not itemizing your deductions, you can claim the standard in order to reduce your taxable income, which counts unearned income. So really, this individual can have up to $52,400 a year without paying any federal income tax. By just living off the dividends, he would need to have about $1.5 million worth of Coca-Cola stock, or 31,000 shares. There are some people that have this much, and we need to once again think about this, because earned income and unearned income is not the same. I'm trying to now think, well, what is the equivalent amount I need to earn as an ordinary worker in order to equal the after-tax total that this unearned income earner is living on? And if you have a job, if you go to work, you have to pay 6.2% Social Security, 1.45% Medicare. Oh, and of course, you pay federal income tax on your income up to $40,000. For your taxable income, from 0 to 9,000, you're paying 10%. From 9,000 to 40, you're paying 12%. And then over 40, you're paying 22%. For unearned income, people living off of stock investments or just dividends, they're not paying Social Security, they're not paying Medicare, and they're not paying federal income tax. I did the math on what you would need to earn as an ordinary worker earning earned income versus somebody earning passive income. And this is the math if you want to freeze the video and go through it. But basically, if you were, for example, a school teacher working 8 hours a day, 5 days a week, 50 weeks out of the year, and your raw income was $62,000, you think, $62,000, I'm doing pretty good. Well, your taxable income after taking the standard deduction is $50,000. And between Medicare, Medicaid, and federal income tax, you will be paying $10,343, leaving you with an after-tax amount to live on of $52,400. But the passive income earner didn't have to pay any taxes, so it's like he gets an advantage. Just by owning $1.5 million worth of stock in Coca-Cola, he is getting a total income this year of $52,400, the same as the school teacher going to work every day. He is paying nothing in taxes, and he just gets to live on that $52,400. Now, maybe I'm being a little harsh on trust fund babies or rich kids, so let's go ahead and look at a scenario where this is the design, this is the intent or the purpose of this tax structure. Let's say you're going for a married couple. Now, the long-term capital gains tax rate for 2020 for a married couple is you pay 0% on unearned income up to $80,000. This is a couple that did everything right. They worked professional jobs, they stayed out of debt, they contributed to their IRAs, 401ks, HSAs, and maybe even additional money in a private brokerage account. They lived within their means, they're now retired, they can now draw money from these tax-deferred accounts in order to live on their investment income. How much can they live on without paying any taxes? You have to factor in the up to $80,000 they pay 0% for long-term capital gains, plus the $24,800 for their standard deduction they can claim for filing jointly married. So their total income that they can have without paying any taxes is $104,800 a year as a married couple. Let's go ahead and make this simple and say their entire lives, the only thing they ever did was buy total stock market index funds, low-cost index funds, and they bought VTI, Vanguard's total stock market index. This ETF currently has a dividend yield of 2.43%. So how much in stock do they need to own in order to live on the dividends? Let's say they're not selling any stocks, they're not living off capital appreciation. They're just living off the dividend income. They would need to own $4.3 million worth of this stock in order to get a dividend distribution of about $104,800 a year. So they would need about 30,000 shares of VTI, which some people out there have. Once again, I did the math. You can pause the video if you want to look at it. But let's think about the younger married equivalents. Let's say we have a young working professional couple. She's a paralegal, he's an HR coordinator. Their combined annual income is $131,000. They think they're doing pretty good as a household income. However, their taxable income is $106,000. And this year, between Social Security, Medicare, and federal income tax, they're paying $26,825 with a leftover amount of $104,800 to live on. The exact same as the retired married couple living off of passive income. And I can't help but compare these two scenarios. And yes, I am younger and I have a job and I'm working, and I think about it and I'm just like, is this real? Is this really how our tax structure is formed, where two people who work jobs earning an income are paying almost 20% in federal, social, and Medicare? I'm not factoring in state income tax or state taxes on investments into any of these calculations. Obviously, every state is different. You'll have to look it up for your state. But just compared to people who collect passive income from retirements, they pay no taxes. And when I look at these two scenarios, the only thing that comes to my mind is I need to stop working. I need to quit my job. And I wonder if the way that the tax structure is currently designed, is it actually a disincentive to work a job? Because if you work a job up to that $40,000 or $80,000, you have to pay your marginal tax rate on federal income tax first. It'll then bump up what you earn from passive income into that 15% tax bracket. And if you have enough money, there really is no reason. There's no reason to collect a salary or work for a company or a business and earn an income when you have enough passive income. You're just going to end up paying more in taxes. I'm just astounded that this is the way it actually is. In the future, I'll make another video kind of like expanding on what I'm trying to reflect on right now. But how I view it and how I'm going to describe it in the future is there's an escape velocity. You have to work a job unless you're born rich. You have to work a job and earned income that you're paying a lot of taxes on to the federal government up to a point. As soon as you can reach your escape velocity, escape your job, for earning passive income, and it doesn't have to be this maximal non-tax amount. You know, if you just learn to live with less, or pay off your mortgage, or reduce the amount of bills, you know, always buy used cars. There's lots you can do to decrease your spending. And as soon as you have $500,000 or $1 million, you can just quit your job and live on that passive income and then never pay taxes again. My second thought is that in the future, this could change. These are the rules right now. Do I like these rules? No, but what happens in 20 or 30 years when I become that investor class, that retired investor class? You know, am I going to then vote to increase the tax rate on long-term capital gains? Because that really is where all of the nefarious, just outrageousness, in my opinion, is occurring. If I had to vote today, I would say, hey, make the lowest bracket for long-term capital gains at least 5%. At least 5%. Make everyone chip in something to the federal government. You know, we all benefit from having a military. We all benefit from federal services provided. So the fact that you can earn as a single up to 50-something thousand, or as a married couple over a six-figure income, and contribute nothing, pay nothing in federal income tax to your government, I just don't think that's right. Okay guys, if you enjoyed this video, give it a thumbs up so the algorithm knows it's good. In addition, consider subscribing to my channel. I talk about finance and investing topics. And if you have any questions or comments, leave me one down below. I love hearing from you guys. And until the next video, take care.